Hi guys, it's Malin. I feel like a preschool teacher. I see Meg, I see Gina, I see Michael, I see Jill. Anyway, we are gonna just wait just a couple minutes, guys, and then get started. Hey Jill, can people, are people muted?
Yes, they're muted as they are entering.
Okay, and they can unmute themselves if they want to, although we are probably going to have people chat first. Yeah. No, I mean in terms of people being able to speak. I think people can unmute themselves. Is that correct, Jill?
That's correct. They're muted on entry, but they can unmute themselves.
Okay, great. Okay, so we will just wait a few minutes for some stragglers.
Okay.
And then we're also, let's see. Oh, and Jennifer Tejada. I see Martha. Great.
That's awesome. So you're able to see more people than we can. Awesome, Jennifer's on.
So the people who just joined.
So we have to talk about PagerDuty.
Yeah, we will talk about PagerDuty. And we have Claire, we have a bunch of folks joining. So people, you're automatically muted when you come in. We have a couple of ways that you can ask questions. I know sometimes it's hard to ask questions when you're on a big phone call, so you can chat it to Operator Collective. But let's just wait one more minute and then we're going to go ahead and get started. But thanks for making the time.
Mm-hmm. And it's probably not too late to say Happy New Year.
Yeah, everybody. Exactly. Happy New Year to everyone.
Yeah. And happy almost Lunar New Year.
I was about to say, we're about to have a new Happy New Year. Thank goodness we're not traveling with the 30 million people that are about to get sick.
Oh, gosh.
There's a big
New Year
happening.
Okay.
Perfect. Thank you kindly.
Okay, guys, this is Malin, and so we're going to go ahead and get started. First of all, thank you for making the time today. This is our first of the official sort of OperatorED session, so would love your feedback afterwards about how to make this most efficient. How do we answer the questions? Because if you're thinking it, somebody else is probably thinking it too, or has the same question, or if you have a creative idea on how we can do these better, please also let us know. So first of all, I want to say thank you to the folks who have planned this, which is Monique Covington, who's sitting here in the room with us. Monique, who's an LP, she's a co-founder and VP of Administration at Rocket Lawyer, as well as Anat Maisel, who is an attorney, is also an LP, an attorney with Fenwick, who's letting us borrow this conference room, and her team here, which is great. And then also our two hosts, of course, Susan Kimberlin, who is an LP, and also Courtney Broadus, who's also an LP. And they are on video. If any of you guys happen to be on video, you can see that they look very lovely sitting here together with a little logo in the back. But let me start. Let's just jump right in, and let's tell them a little bit about your guys' background too, because you know, as you guys know, with Operator Collective, we actually have about 70% of our Operator LPs have never invested in venture before, and so part of this is is education. But you guys are the exception in that you guys are part of the 30%, which is you guys have been active angel investors. So I thought that we could use some of your experiences to educate people who might just be dipping their toe in, right? Because for most of these people, Operator Collective is their first investment.
Yeah, delighted. Mm-hmm.
Great. So Susan actually started her career at building NLP search engines for startups and moved to product management at PayPal and Salesforce for a number of years. She's an LP in Operator Collective and also in Backstage Capital, which is Arlen Hamilton's fund. And she started angel investing in 2014 with 2 investments, and since then has invested in about 30 companies. And then Courtney Broadus, who was a Salesforce colleague of Susan's. She joined Salesforce in 2000 as the first woman on the engineering team and as the first tech leader. After 10 years at Salesforce, she built 7 engineering teams, and she's been a full-time angel investor and has invested in 45 companies.
46.
46 companies, and doesn't usually invest in funds, except
No.
for
This is a big exception, you guys.
it's this fund and Ron Conway's fund.
Yeah,
the infamous
SB
Ron Conway.
Uh-huh.
And in the future, we will be the infamous Operator Collective Fund.
Yeah, exactly.
So great. Thanks so much. So let's just jump right in,
Thanks for having us.
which is why. So I guess very quickly, why you decided to get into angel investing, but also like, how did you make that first investment? Because sometimes the first investment is the hardest.
I totally agree. Susan?
Well, for me, it was a little bit opportunity and a lot kind of the stuff that I'm interested in career-wise. Like Mal mentioned, I was at Salesforce for a long time. I was there during growth years, not as early as Courtney, but I had a lot of people in my broader network that had been at Salesforce for a long time, helped build Salesforce, and then gone on to start other things. And I had an opportunity early on to invest in a company that a friend and former colleague was starting. And because it was in the space of enterprise SaaS, among other things, it was something that I could really understand. And so that was an opportunity, got to invest very early on, got to kind of learn a little bit. I'm also a product manager by both training and trade, and I love new products. I love building things and putting them out in the world. And for me, it was really exciting to work on a company very early stage and be able to help move that thing, that product, that team, that organization out into the world. So that was kind of what drew me in. And then, of course, there seemed to be a lot of upside to putting money into an early company, which, we could get into like,
And a lot of
There's a lot of downside too. We'll talk about that. Not to worry.
Absolutely will.
And so, Courtney, what was your,
Courtney?
how did you get into it? I mean, obviously you have a lot of experience too, and how did you get into that first investment?
Yeah, well, it was so similar. I was leaving Salesforce, and I had really enjoyed focusing my entire career on delivering innovation with excellence, and I wanted to figure out how I was going to be able to continue that legacy. And I felt like I learned a lot in that time frame, and we hadn't been great as a company about doing anything outbound at that point. So I started working with some founders, and there was somebody that I had worked with at Salesforce that had been starting a formal sort of investment network themselves, and was pulling in specifically people that they'd worked with. So it happened by accident in the beginning, but it very quickly became intentional. It just was so exciting to continue the work of helping innovation come to fruition, and to use actually what I found to be my most helpful skill was that in building the team of 300 people that I had over my decade there, I probably interviewed, and helping hire a lot of peers, et cetera, I probably interviewed over 10,000 people, and that helped me figure out, who good founders were, actually.
And it's sort of like, I guess, I love Layla's story, right, that she talks about after when she was at Salesforce, she figured out all the guys were asking each other to invest in other things, but they weren't asking the women. Sounds like some of the guys actually asked you. So
they did. So the guy that actually asked me, but still within that network, it's gotten much better, but definitely for sure, yes. So it was not a new scenario to be one of the only women in the room.
So let's actually go back to the basics. So like angel investing, there's, we all know a lot of us are in the startup world, or some of us are not as close in the startup world. And so let's just go to the basics of angel investing, right? Usually angel investing is, there's different stages of companies, right? So let's just walk through super quickly, like the stages of companies.
Sure.
Yeah, sure. There's kind of like 3 sort of main categories that we think about. There's sort of bootstrapped early, that means that nobody has given the company money. Everybody that's working on whatever the company is doing it sort of without compensation, essentially.
And that's when you usually go to like find your family and friends.
Friends and family,
Like your mom, your dog, whatever, trying to get some money.
There's often not a product, no customers. It's
and then lots of times you kludge together like maybe $100,000, or maybe $200,000, or maybe less, or maybe more. Okay, so that's the bootstrap early stage.
Yeah.
And then there's like seed, which I think covers angel investments. You'll hear terms like pre-seed also, but basically before you get to the next phase, where I'm sure most people have heard of like Series A, Series B, Series C. Seed stage is sort of before you get to
the institutional
investing, which is venture funds investing. But there are funds that actually do seed investments as well.
There are.
So angel investing is in that category. It's when there is, you know, some sign that there's a product that you're starting to see signs of the company getting customers, and some things like that. And so you'll see outside investors beyond like friends and family coming in, people like angels, seed funds.
But primarily, I think the thing everybody needs to know is that you just need to ask the founders where they are, how much they've raised, who they've raised it from, because just saying that somebody's at a seed stage doesn't tell you anything about what they're raising or how much they've raised or what they've done already. So yes, there's a lot happening now in that pre-institutional phase.
So a lot of people, so a lot of angels join at sort of if it's not a friend and family thing, right? A lot of them join basically at the seed and pre-seed stage. But you're actually starting to see more and more angels, you know, joining at, you know, the Series A or the Series B. But of course, the returns are going to be less, but the risk is also less.
Much less. Yes. Yeah. The primary thing to understand is that when you're talking about the seed stages, whichever one it is, there are no metrics. You can't make your investments based on the same, you know, the same information. There's very little information. You know, they might have some great up and to the right charts, but it's based on 5 customers, you know, if even. And so it's really challenging, and that's where your sort of picker on the founder having the right hustle on the way through and seeing what their network is becomes very important.
So you guys are both enterprise people, and obviously Operator Collective, our focus and our core is enterprise and B2B software and technology. And so talk a little bit about sort of the areas that you invest in, because there is actually some counterintuitive things. And let me pause for a second before you answer that, because what I heard again and again from a lot of the women who are now part of Operator Collective, which is a lot of them didn't invest in enterprise, even though that's what you know.
Right.
And sometimes you don't realize that you know a whole lot more about investing than you think you do. Just like, okay, I've hired 10,000 engineers. Okay, you do know something about
maybe a little.
But what I heard is what happened a lot of times was, and again, I'm generalizing with these women, is like, okay, I want to angel invest. So a lot of them start and say, okay, I'm going to invest in what I know. So they actually end up doing a lot of consumer companies, which is obviously not what we're doing, and particularly, you know, it's fine, you can do that on your own. But then I also heard that consumer companies are hard, and so a lot of them actually ended up losing money. And so
definitely been my experience.
Okay.
This is a hard way to get started.
Exactly. Because the idea was, well, we'll talk about like risk and return, but the idea is actually to try to maximize your return.
Right. It is.
So let's start with that, because
why not to do consumer? I'd be happy to answer that.
Well, tell us a little bit your experience, and like, because I think that it's a natural way. It's like, I know this meal delivery service would be great, and this ride share, and I want all those things to be successful.
And that's the number one. So the mistake that I learned the hard way by having lost the money is that it's a very easy lesson to learn. So hopefully you all can learn it from me instead, which is because you can see yourself as a consumer of it, that has nothing to do with whether or not the company will be successful. Do not confuse that with your domain expertise, which is what you really want to be leveraging in this situation. So what can your network help with? What do you already know? How can you leverage your skill set that you don't even realize that you have? Consumer is really difficult because there's a lot of competition. It's really about eyeballs and distribution. The very beginning of it can be amazing and the very end of it can be amazing, but that middle part is really difficult. And even though there's roadmaps in terms of how to get there, it's all about exposure. The customer acquisition costs are insane. There's a lot of money that has to be spent upfront to get the customers. And so all of the times I made a mistake. There's one mistake I didn't make, which is great, but it's not entirely because of me, but I think it's because of the picker I talked about. I think I really picked a great founder. But all of the other ones, I absolutely saw the pain point. I thought it made sense. I knew that I would want to use the service myself, and they all ran into hiccups fairly quickly because it's really hard to get enough. The number of customers you have to get is literally inverse to enterprise. Enterprise is its own ball of wax, but I understand enterprise, so I know how to evaluate that.
Yeah, I think that's a sort of a lesson from product management that I learned, is never use yourself as a yardstick for measuring whether something is going to work. You have to really know your market, know who is actually going to use the product, who's going to consume, who's going to pay money for this product that this company is building.
So now that you guys have had almost 100 angel investments between you, some have lost money, some have made money, you've been able to see patterns. What are the specific criteria that you look for now when you decide to angel invest?
I've got like a short list with 3 sort of main things. One is like the company itself, which at the early stage is really just the team. often, you know who is working on it, so how likely are they to be able to like carry this thing through to success, and then the product and service itself. And I like to look for, do I know enough about that company, that space or domain to assess it, and or do I have a network that can help me with that? I really like to do, because I'm investing my own money, and because this is important to me, I like to invest in things that align with my values. So for impact, I like to do things that are good and useful, in like good things to exist in the world. I invest in diversity, both founders and in products and services that help encourage more diversity in places that need it in the economy. And creating opportunities for people that might not otherwise get them.
And I think that's also something to be clear, right? Which is, when you're angel investing, you need to decide why you're angel investing.
Yes.
Right? Are you doing it just for financial return?
Right.
In which case, it's actually a very risky way.
Yeah, don't do that.
It's
risky and hard, actually.
Or is it because you want to work with these people and you want to help them, even though it might not be a home run, or you might,
yes.
Because I think going into most angel investments, you got to assume your return is going to be zero.
Yeah.
Actually.
Yeah. And so that's a weird proposition. We talked about that. It's a weird proposition to be like, and it's also why you have to decide about spending your time with someone. There's plenty of times that both of us have decided not to invest in a particular company or a founder at that moment, but we spend time with them and we invest in the people and try and get them to a certain stage. We've also learned over time that a lot of times that's irretrievable. So over time, that's one of the lessons you were asking about that we've learned, and it's how can you assess maybe a little earlier that this founder is going to make it. I look for a lot of hustle and a lot of that they follow up crazy, in crazy ways. My number one advice to founders is always be asking. You never know where the help will come from, and more people are willing to help than you realize. But absolutely, I mean, I think we agree on the criteria. I think your domain expertise just can't be underemphasized.
So let's take a specific example, and also I'm going to pause for a second. For those of you who are on the phone, you can unmute yourself to ask a question if you'd like to, but also you can chat it if you're online right now. Chat it, and then we are monitoring the questions, and we can throw those in. Okay, so let's give an example. So we have Jen Tejada from PagerDuty, who's on the phone.
Yay! Fangirl.
We're all fangirls. And we're all big fans of PagerDuty.
Yeah.
And you're an investor.
I am an investor.
So let's take that as
holding strong onto that stock.
So let's take that as an example of like, why did you decide to invest in it?
Yeah.
Because clearly that's not a consumer company. It's clearly a space right?
It's very much. So the thing about that was it was really amazing. And it hit all of my criteria that we were just talking about. It was smack in my domain expertise. For those of you who don't know, it's a company that does incident and identification management and helps data centers and production centers do what they need to do best and know exactly what's going on at any time. We could have really used it at Salesforce. It was part of why I knew how important it was because we certainly weren't able to build it ourselves. And so it was obvious. It was right in the middle of my domain expertise. It was at the right stage. It was a Series A when I got to invest, so a little bit before Jennifer's time, but I'm just saying I was prescient. I knew it was going to be run by a woman, so that was, very exciting. And it came from a trusted source. That's another important thing to understand over time. And this trusted source was not only somebody that I trusted, but because of who it was that brought it in, that was a differentiator. So that's one of my sort of pieces of advice over time is Operator Collective is a great place to start, and you'll be able to learn through that sort of which other LPs work in areas that are similar to yours, and then you can start building up more of a relationship with them. But at a certain point, if there's folks who do this a lot, they can actually, their participation is actually a differentiator to the company. And so the participation of this trusted network was, it's sort of a double usefulness there. It wasn't just that I trusted that they know how to, do the due diligence, but also that their participation and therefore, everyone else who is participating would actually help this company be successful.
So that's a great point, because whether you're angel investing or you're investing as a fund, as we are obviously, is that one of the things we look for is who else is supporting this company as they need to be successful. Because we all know no one does it on their own. And so we definitely look for that to say who is going to help accelerate, because one fund alone is not going to be able to
make it all happen,
hustle this company forward. And to be able to do that.
And that's part of our advice as we were talking about getting ready for this, for talking about this today, is that, in the beginning, you can feel like you don't have a network, but you actually have a very, very big network. And one of the things to start realizing is if you want to get into doing this, is you need to reach out and let people know, hey, I'm interested. So like Layla did not have happening, you want to have the deals coming to you. You want people to be considering you in this area, but also you need to reach out. If you have a really interesting company, but maybe, you know, PagerDuty came to you back in the day and you knew that I knew about it, but you didn't, then I'd be a great person to ping. And so part of it is just, you know, developing the people that seem to be interested in the same things, and then we'll bring you in.
And it's very much sort of a pay it forward kind of thing
Very
when it
much.
comes to networking. You put the opportunity out there. People that are interested and are excited will get back to you. And if they you know, if they don't, it doesn't hurt you.
It doesn't.
You're just presenting an opportunity. So I think, you know, that's an important thing to.
It's very important for all of the operator LPs, you know, LPs, because we know that that's what you're all doing right now, and we want to. Susan and I want to encourage you that asking people to participate or to ask them just what their thoughts are on a particular deal or a company is not the same as using up your capital to work on a 6-month project and asking them for their team. So some people that you might only want to bother, whether it's because they're senior to you or they have services that you need, and that you only want to bother once a year because they, you know, you don't want to ask them too many times. This is an entirely different prospect. So you kind of need to take that operator hat off and think of, like, here are all the people I know that either would be interested in this deal or can help me understand this deal better. And don't, you know, don't hesitate. The worst that's ever happened in 10 years of me doing it, and, you know, 6, 8 years of you doing it, is they just don't respond.
Yeah.
We've never had anybody be upset or like, why are you sending this to me?
And it's like a fun reason to reconnect with
Yeah,
people.
exactly.
Absolutely.
Yeah.
Talk about something. So one other point on who's the community of angel investors. One of the things that I guess surprised me a little bit was that there's certain angel investors. There's different schools of thought of angel investing. There's like the Elad Gil school of thought, which is like you have a lot of liquidity, which he does.
Yeah.
So he invests in
Everything.
everything.
Yeah.
Everything. So a lot of founders will say, hey, I have Elad Gil who's invested in me. But when you go talk to Elad Gil, Elad doesn't remember.
Even know what the
He's like,
company is.
if I'm invested in this company, I'm not that active.
Right.
And I'll be like, you don't remember if you're invested, do you? And then there's the Dan Scheinman School of Angel Investing, and Dan happens to be, and you'll see which one we're more aligned with too, right? Which is like, Dan is one of our investment committee advisory members, and he's an early investor in Zoom and Arista and a bunch of others. And so he obsesses about every single angel investment he does. He certainly has the liquidity to do the Elad Gil approach. And again, it's a totally different strategy, so I'm not saying that Elad's is wrong. It's just different from ours. And so he obsesses about every single. So knowing who else is an angel and knowing what their strategy is does have input, like impact into like whether or not you're gonna say, oh, credibility, right? Because so-and-so decided to do it.
Yeah. I mean, in the one sense, like you said, there's nothing wrong with that. It's a different way of gambling, right? You're just going to place all the bets, and that's fantastic. And he can obviously afford to, but I don't think most of us on this call can do exactly that. But even if we could, it kind of goes back to the earlier question about setting your intention. Why do you want to do this? And for both of us, our intention is very much around, we want to impact the future. We want to impact the environment that we live in. And to do that, we need to be more focused. But I did early on, take an approach of, it wasn't invest in everything, but I did decide very early on that I knew I was going to make more than a couple of investments, which is important because I have had, 7 failures in those companies. And if I'd only invested in 10 companies, this would look like a really stupid thing that I did. So I knew I did have to place a lot of bets, but it was over a long period of time. So that was like a very active, when it got pulled into it by accident, then I made an active decision.
Yeah, and most people I know describe angel investing as community service.
Yeah, kind of. I agree.
Yeah, I mean, it's a lot of supporting. It's actually one of the things about angel investing is that you bring in some capital, sure, but it's important to bring more than that. I think at that early stage, these companies need a lot more than just the money that you're bringing. They need network, they need advice, they need sometimes they need a little moral support when things are hard.
Yes.
And so there is definitely an element of finding a community that can help the companies that you've invested in and being supportive as well.
Yeah, and connecting them. Absolutely.
I think in my nature and in a lot of really effective
let's talk about some specifics. People don't talk about money very much.
Yes.
Right? So let's talk about
women in particular don't.
Do it.
And we want to give you all permission to say, I want to make money.
Because a lot of us are operators, a lot of us maybe weren't founders, a lot of us maybe have the gender pay equity gap, whatever. And so maybe we just don't have the money. And so it's daunting to say like, oh my God, I don't have $100,000. But when you actually start digging into it, you realize people actually usually don't put that much in.
No.
Especially at the early stages.
No.
So talk a little bit about like Susan, what's your, if you're willing to share?
My default check size has been $25K for 5 years. Both of us, yeah, absolutely.
I've been doing that for 10 years.
That's funny. It hasn't changed over the years.
No.
I find that I have been moving earlier and earlier because
in order to keep the check size
number, like, yeah, exactly. Like, things are more expensive now than they were 5 years ago.
Yeah.
But yeah, like 25K. But you know what? I see a range especially when, you know, when a company is really early, or they're doing something that they're really kind of outlier, they're not well networked, especially in Silicon Valley or in tech, then they take smaller checks and they're happy to have it as long as, you know, there's some expertise and help that comes with it.
Yeah, you can, one of the ways you can get away with putting in a variety of different check sizes is by getting to know the founder and spending time with them. And then at a certain point, especially if you are able to help them with things, if the founder is worth their salt, they will understand that a connection that you've made is worth more than 25 grand to them, particularly. So it's good to start out with that. And certainly, you know, you should expect that for the most part, you're going to have to go pretty early stage. So there's going to be a lot less data, a lot less information, so a lot more risk. But that is a way to be able to do that. But yeah, it's important to understand if people are telling you that you only can put in 50 grand or more, it's not a good fit for you. Don't try and, you know, it shouldn't make you feel bad. That's just not a good fit, and move away from that.
Because the nature of a angel portfolio is that most of the companies you should expect will fail.
Yeah.
So unless you have endless liquidity, if you put 50K times 10, 100, that's a lot of money
to lose.
And what I'm also seeing these days is, you know, this is on our side, people are wanting to diversify their cap table.
Yep.
And then they also see that people who are operators, who are all the people on this call, right, actually can help. Can help more than the people who have never operated before.
It's very
true.
They're
actually taking checks that are 5K and 10K.
Yeah.
And so don't be hesitant about saying, hey, this is all I can put in.
Yep.
And because you can do a whole lot more, especially as you're learning the world of angel investing. You can you can do 5X.
Yeah, I mean,
and my first one, that was exactly what I did in the very beginning, because I was unsure and I didn't know how trusted, because some of the people that I co-invest with, we were all sort of beginning, so none of us knew exactly what anybody's track record was. I would say, can I just put 15 in or 10 into that? Several of those did really well, so I now feel very stupid about that. But you know, at the same time, a couple of them didn't do well, and I'm very happy when I see one of them fall apart. And I'm like, oh, thankfully that was only 15, not 25.
I bet you learned something.
But
another way that you can think about that, think about what you put in or what your budget is that, like, on top of money, there's also your time and your network, right? And your time and your expertise is arguably sometimes more valuable than the actual dollars. So if you're thinking, wow, I don't have a lot of capital to put in, but you have something that you know really well and you can help, that is an incredibly useful thing that you can put in as well. And it's possible to do things like advising and get compensated with equity for that. So. Those arrangements.
So the two of you, you have a lot of things going on in your life, but largely you guys are essentially full-time angels.
Yeah, right.
Right. And so because angel investing is a full-time job, if you really want to do it, seeking out the companies, helping them. A lot of the people who are a part of Operator Collective are not full-time angels. So they have operating roles, but they want to sort of dig their toe in.
Yeah.
In fact, this is one of the reasons why we created this, which is like, you guys see a lot of opportunity. I'm sure everyone on the call sees a lot of opportunity, but to really dig in, you either will put it in because it's like, hey, not a big deal, or I know this person, I'm going to do it, and I know I'm going into this relatively blind.
Yeah.
But one of the things that we're doing is trying to, because I saw, this is why only about 10% of women are angel investors. I think it's going up a little bit. It was like 7%. Now it's like 10 or 12%. Was that because, one, women don't have the liquidity, right, to just sprinkle and not care.
Yes.
And the second, women don't want to just sprinkle their money and not be involved.
Generally not their MO.
And I'm generalizing with women.
Sure.
It's underrepresented people, immigrants, all that falls into this category. And so one of the things that we did, right, obviously, was that so that if you have an opportunity, you can bring it to us, we can take a look at it and help be that network of reaching out to everyone else to see whether, in fact, we should invest, or if we decide not to invest, it's help you meet other people who might invest. Right. And the other thing is when we do that, we haven't really mentioned this, is like, if you bring us an opportunity and we've decided to invest, we'll always tell you whether we've decided to invest. And if you want to, you should say, hey, can I put in 5K? The founder will absolutely do that, especially, or 10K or 25K or whatever it is.
You hook them up.
Because what you can do then is—
You're right, that's another way to get away with putting in less money. If you connect them with somebody who then funds them, then you should be able to put in $5 if you want.
And then what you were able to do, and then like we're happy because you brought us an opportunity.
Right.
But then second is you didn't have to do all the work
Right.
because you're not a full-time angel. You're someone who's, you know, got a full-time job, and a lot of us have young kids at home, et cetera, et cetera. So you can also leverage that to say, okay,
Yeah.
still angel investing is still going to be risky, but it's de-risked a little bit because there's been a whole lot of diligence that we've been able to tap. And so that's one of the reasons why we did do this, right, was to create a more efficient way of doing it as opposed to you got to quit your job and be a full-time angel.
Absolutely.
Most of us can't do that.
Yeah, the due diligence can be overwhelming, and that's part of why we mention network so often and why it's important for you to start developing that. An operator, you know, collective is obviously a great place to start.
So that's a little plug for us. So if you do get some leads, like feel free to bring them to us. And we are usually very quick about saying, hey, you know what, we don't do consumer, or this is something outside, or this is a, you know, too heavily in this area, but we will always try to find someone within the community to refer them to other VCs, et cetera.
Right.
So let's talk also.
Can I make one point, just because you mentioned in terms of liquidity and other things? So the thing I think is most important to make sure everybody understands is that you shouldn't even be considering angel investing if you don't already have a portfolio. Like your money should be, whatever money you have, even if it's $100 grand, should be in, you know, not just in your checking account or your savings account. It should be in, you know, bonds, stocks, whatever. And you should have some understanding of what your low risk investment is and your high risk investment. And specifically, when I decided to do this, I took my CRM stock was in my high risk, you know, category of things. So I sold a little bit of that and decided this is my budget. And it was in the same category. So angel investing is very high risk. Owning the CRM stock is actually over time turned out to be less risk, but at the time I did this, it was pretty risky, and it was definitely, you know, having that concentration in, you know, one stock was risky. And so I kept it within that same category. And then over time, after I've been doing it for 5 years and had seen some exits and felt a little more comfortable, I decided to increase my budget, but that helped me stick within a budget. And I sort of operate like a fund, you know, it's like I have this amount of money to spend, and once it's spent, I have to wait for more liquidity to come. But I highly encourage people to think about it that way, because that's the only way that you won't, you know, you'll understand that it's restricted funds, even if you have a little bit more. It'll provide some discipline, and also it should lower your consternation, because you should be willing to lose that money completely, no matter whether it's in that one stock or it's in that one company.
Yeah, I have like, I like to think of it, especially if you're doing it just a little bit and don't have a ton of experience with it.
Yeah.
It's a little like going to the blackjack table. You have to be prepared to never see that money again.
Yeah.
So
that's important.
So that if that happens.
She says blackjack, I say it's like throwing money out the car window and then magically being, you know, further down on one and it flies back in. Like it's just about that, you know, 1% of companies that you invest in will actually have a successful exit.
Yeah, and so when I've talked to a lot of angel investors, and I think the school of thought is, well, let me ask you guys this, do you guys, so you do the initial investment usually as early as you can. How often have you joined a follow-on?
Follow-ons are my favorite. I used to not have money to do that because of the budget, so that's one of the areas where the exits are things. I love doing follow-on, and follow-on is when you put more money into the same company. And it's my favorite thing to do, particularly with female founders, which is something that I like to focus on. But it's amazing. And actually, it's one of the few things, I don't want to get technical here, but when we're investing at such an early stage and when we're individuals, we don't have a lot of leverage, but it's one of the few things I try and write a little side letter about, which nobody here needs to know about, but it's something that I ask, which is to have the right to invest in the next round. And that's not something that a lot of angels have a lot of power over unless you're investing as a group. So like Malin has that power and Operator Collective has that power, but me as Courtney Broadus doesn't always have that power.
Yeah, so let me take a moment and just explain that, because it's not entirely obvious.
Yes.
And you don't know to ask for it. And you won't always get it, but lots of times, but you may. Because
you always be asking people.
Because of the nature of who we are,
yes,
you actually could probably get away with it, right? Even though a normal person wouldn't. And so when you make that initial investment, what you do is you ask for the pro rata rights to join the next round. Because if it's a super hot company that's doing well, they try to squeeze everyone out, right? Because they want to make room for the new investors, and they try to squeeze everyone else's back, and look, you're already in the company. And so you can ask, like, and people may look at you like, what are you putting in 5K and you want pro rata rights? You know what, with utter confidence say, yes, I do. Because I add a lot of value.
Right? And I'm investing in you right now. Like, you believe in yourselves, but I'm investing in you when there's no data, there's no metrics, nobody knows you. You might have 0 customers. You might not even have products yet.
Yes, but don't let anyone intimidate you. Be like, nobody gets that. And because we get that question a lot, our entire business model, and like, but we get that. And so you should feel confident because of who you are and what you're bringing to the table to say, I want pro rata rights so that in the next round, I have the right to participate. So that's just.
There was a YC-backed company that I talked to a long time ago, who I will not name, who not only refused to let me invest less than 50K, and this is their first fundraise, but also wouldn't give me pro rata rights. And I was like, forget it. And I've never regretted it. And they did not do well.
Probably not a good fit for you and that company.
No, it wasn't. And it was all because, and this is, so to even put a little more flavor behind that, a lot of what's happening is it's not even usually the founder that has that opinion. It's the biggest funder that's helping them. And that biggest funder, you know, or the institutional one that's looking to do, you know, whoever the fund or the VC is going to be in the Series A is trying to keep things clean. But there's, you know, they talk about having a clean cap table and all these things. It's all made up. There's no such thing as, you know, there are cap tables that are a mess, but not because they took $5K from somebody and gave them pro rata rights. Like, that's not the problem.
So we have a question from Allison, and also I'm gonna in a second I'm gonna tell you guys to ask more questions, and also I'm gonna pause. But if anyone wants to come off mute and ask a question, go ahead. But please prepare yourself. Okay, so this is a question from Allison. Thank you. This is a great question. Have any of you invested in a company that reached out to you on LinkedIn, or do you only filter for companies introduced by mutual connection?
Oh, that's a great question. I don't think I have seriously considered a cold outreach on LinkedIn.
No.
But I think also we get a lot of, I'm sure all of us get a lot of cold contacts from LinkedIn. That being said, I do read pretty much all of them because I think there is something that I think it's more inclusive to at least give something a glance. It's kind of, you know, but you have to be aware of how much time you're spending on these things.
Yeah.
So no, and like the rule of thumb is always that a warm intro is way better than not.
If I were a fund, I would. I've actually spoken with other people who do that, or if you're a scout, or if you're doing other things, you know, you're looking for what's coming and maybe it's not quite the right time. I would definitely, and I know of people who have and have found great deals through all that. For me, given the space that I'm in and what I do, I also happen to be not a venture partner, a venture supporter or something of a organization, and I'm not super obviously active with them. And so when a lot of times that's mentioned with the thing that comes in, so I know they don't know me or anything about me. You know, that it's not the primary thing I'm focusing on. So there's an aspect of that yes, I think just in terms of where I operate, it doesn't mean that it's not a useful thing for other people. Maybe there's a space that you operate in that makes sense. But I also have a lot of pipeline, and that's the thing, is that I already, you know, I've over this time built multiple different networks of people, and so there's a lot that I'm already seeing. I'd rather make sure that if I have limited time, that I'm spending it either on a founder that I already know, or with some of the networks that I've built up over these 10 years.
Something totally from scratch is very hard.
It's very hard.
Very hard.
And here's another thing. So what I will say is not only that, only once in my whole history of investing did I even take a call with somebody who wasn't second connected to me in LinkedIn, and it was not worth it. Mm-hmm. So like, I at least want to see that you're somewhat connected to my ecosystem. So unless it's like an unusual situation where I have a friend that works and has a, you know, helps a fund over in Australia, so clearly those folks are not going to probably be in my network unless it's already vetted and coming in through that way. That's another thing that I look at, because if they're not even a second, then I'm worried about what their ability is to make things happen, because they're not connected to at least somebody in a tertiary way. Mm-hmm. So I actually use it as the opposite kind of filter.
The other thing is what I know that people have so Twitter is another way, right? Twitter's interesting because there can be a cold reach out where you decide whether to take it or not, but there might be something that says, okay, I'm going to take this call. But then what I do is that you build a relationship from that sometimes. But usually, right, there is some connection. If they're a third, you're so in different worlds. It's just even hard to have anything. But people have, I think, gotten a lot of opportunities via Twitter, especially like a couple of our I'm not a super active tweeter, but we have a few super active tweeters who are also super active angel investors, like Allison Barr-Allen and Dan Scheinman, and I know that they've actually gotten a lot of theirs through Twitter. But I think it's just,
that's crazy. I never thought of that.
But what it is it's just the initial, it's just the intro, and then it's like you get to know them, and just like what you guys said earlier, which is, as you start to meet with them, how did they respond to that meeting? How did they send you a thank you? Did you connect them with other people? How did they respond to those? And so I think that's what it is. But I think it is very hard.
And that's the pattern matching you were asking about a while ago. Like, that's some of the pattern matching. It's just seeing how people follow up. And if they, you know, are dropping the ball or making it difficult, I literally just had to not invest. I should have 47 investments, but I just decided not to, because I followed up probably 5 times with the founder to give her money, and I was not getting the follow-up back. So I said, well, I don't think that this is going to be a smart decision.
But I think it also, that for stuff like that, it kind of depends on how much people outside of your, people who are outside of your network know about what you are interested in and what you would do as well. So like if you have a big Twitter persona and, you know, it's really clear to the entire world, or it's very public, like the kinds of things you're interested in and what might drive you, then like it maybe makes more sense for somebody outside to actually have something that's worth your time to look at, because they know that that's your interest.
That's the same with the LinkedIn thing, is that actually in terms of getting those cold things, it's almost all consumer, which is not what I do at all. And if not, it's something else. But so, you know, sometimes I won't look at the whole thing, but I'll just sort of, you know, see what comes through in the email, and I'm just looking at the header, and unless it says, like, it's screaming like SaaS, enterprise, blah, 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 I won't look at it further.
So let me just pause and see if anyone wants to unmute themselves and ask a question, because I know not everyone's online and able to chat.
This is Jennifer Tejada. Can you hear me?
Hey. Yes,
Hey.
we can hear you.
I don't have a question. I'm sorry my video is not on, but I'm actually multitasking. The only way I was going to be able to dial into this is if I could also do some work at the same time. I really just wanted to say thank you. I am not a super active angel investor. I tend to opportunistically invest in things that are interesting to me or people who I'm really interested in. I definitely see it more as community service, and I consider every investment I make as money lost. And it's a happy surprise if it's not. I've been quite lucky, but one of the things I don't do very well is telegraph that I'm interested in making investments. And I've learned that the reason I don't do that well is because people like to make assumptions. So for instance, we went public. The universe has assumed that I'm now independently uber wealthy. For those of you who have ever been through an IPO before, the CEO is the most locked up person of anybody on the cap table.
Yeah.
Hard for me to sell stock. So while I'm liquid, I'm not illiquid. And so I think I'm not super liquid, I should say. While I do like to let people know that I'm interested in investing in enterprise, particularly SaaS, not just developer solutions. I'm always also very interested in applications. I'm also interested in health and beauty because of my experience with Estee Lauder, but I haven't figured out a way to telegraph that's not going to generate too much demand because of what people might perceive about me, and likewise how to do it in a way where I really am doing it through highly curated networks, and interested in how you'd recommend I go about that, because I'm obviously not going to blast something on Twitter. I don't think that would be a good idea.
I think you follow up with that network. I mean, it sounds like you said that you already have, you know, people that are sending things in, and it might just sort of be one-off. So I think you send, and I think you could get away with, you know, just an email, but basically sending an email, you know, BCCing obviously these various folks and saying, just FYI, here are the types of deals I'm looking at. Here's a list of the companies that I've already invested in. You know, I really like X, Y, and Z, and I'd be very open to being connected to whatever it is that you're interested in. I think that's a great way to start. That would be my first recommendation.
Yeah, I think staying within the networks like that are the tier of your network that is closest to you. And using that as a filter is sort of priority one.
So one thing that we've been thinking about is that, and again, we had to digest the close and all that stuff. But one thing we've been thinking about is, because there's a lot of things that we pass on because we're not a big fund, right? We're only going to make, you know, X number of investments, and we're not going to do a lot of the consumer stuff, although some of the things I want other people to do because I will want to use the product. And so we're thinking about having a different group within, you know, a mailer for people who are active and who want to be angel investors. And it doesn't mean that probably at the beginning we can't curate it to say who it is, but we can actually put out opportunities that are not totally cold spread opportunities. It won't be like the random LinkedIn ones, because I think that's too much for people to filter, but opportunities where they might be looking for a strategic, right? As someone like, anyone would jump at the opportunity, right, Jen, to have you on their cap table.
Absolutely.
So would something like that be helpful to you guys, because that way you're not trying to recreate the network?
I've been thinking about also deal flow, because as a full-time operator, I don't have a lot of time, and that's the biggest issue. So now, you know, I've put out a feeler to some of my CEO friends who I know have been actively investing in kind of like category adjacent businesses. But
Right.
I'm afraid to cast a wider net because I won't be able to manage inbound.
All of that.
It's not curated. So I guess the more direct question is, have you found any success in working through other LPs or other funds as a deal flow source? You know, so like I have a number of investors that people that are on the PagerDuty cap table who I trust. Would it make sense for me to go to some of those investors and just say, like, I really want to tightly curate, only bring me things that look like this, so that I'm not sort of overburdened by stuff coming in and then feeling obligated to respond without not a lot of time to do the analysis?
No, I think that's exactly what you should do. To be clear, I'm not really talking about it because I don't want people to think that they can go join it, but my primary investments and my deal flow comes from two groups that I co-invest with heavily. And that's very important because otherwise I couldn't manage it. I couldn't manage the due diligence. I couldn't manage the focus. One of them is Broadway Angels, which is the top 50. I'm like one of the only women who doesn't have a VC background in it. And it's really incredible, but yes, it's very highly curated, but they invest all over the place because it's 50 women with different backgrounds. So a lot of consumer comes through there. So that's not, I obviously don't invest in everything that comes through, but I think that would be a great idea. Another suggestion is that, and this is for everybody, not just you, is that AllRaise does office hours with lots of founders, and they only pass on, I'm going to get the stat a little wrong, but they only pass on, it's like less than 15%, it might even be less than 10 of the companies that they look at. And so I just get a couple of emails from them every week. So that's another thing that people can do, and it's great because they're generally counseling female founders, and you can tell them, they just put out some information they just started where you can tell them, here are the only areas I want to invest in. So they're not, right now I get a lot from everything across the board, but they're going to try and do better and only forward on things that are in the areas I said I liked.
One thing that we've talked about, Courtney and I,
and we need to work together more, we've already realized. So this is another untapped resource.
It sort of overlaps with what Malin was saying, is that you can work with VCs that are investing in the spaces that you are familiar with or that have invested in your company, in your case, Jennifer. They run across deals, like Malin said, that are too early all the time, and that's a great way to filter because they'll, they have the.
Or even if they're investing, I think that even if you're an early angel investor and you're going to invest less, I would actually say you can invest at the A or even the late seed.
Yeah.
Because you're just at a different place. The risk is lower the later it is because you have more visibility.
Exactly.
And so
if you have less time, you should probably invest in a slightly later stage. You just should. Because then you have to do less due diligence and your network can, help you more.
And you already know what it looks like. And so you guys all, pretty much everyone on the call, right, has those investors that have invested in your company that you know and respect and invest well. Yeah. And as soon as you let them know that you're even interested, they'll be like, oh my gosh. We'll bring
Jennifer, I'm going to start sending you some things.
Thank you.
So you know.
Thanks, everybody. I appreciate it.
So let me pause, see if there's any other questions, because I have a couple of others, but and then another ones that have been chatted. Any other comments too? Comments too, please.
Like all of it.
Okay, so one question, again, that's the money thing. Okay. So this is just one question.
Where it ends and begins.
Which is, when you look at your investable wealth, right, how do you divide it up? Like because you put this in the high risk category, correct?
Yes.
Right. And then, so when you look at it, do you put that 20% of your net, like 10%, like what? And when I started, it was originally like $100,000. I just said, that just seems smart. And at the time I said, that's 4 companies. Right. So I felt like that I wanted to do 2 things to help. I wanted to diversify my bets. So I didn't want to put $100,000 on one company. I wanted to try and do that. It actually went further because, as I said, I was able to invest in a few at $15K. So that's part of how I think about it. And I also think about it is exactly how I, mentally think about when somebody's asking me to put in more than 25. I'm like, well, how many more companies? Now that's 2 companies. Now that's 5 companies. And so I'm always doing that math in my head of whether or not do I feel like that I can expand somewhere, because I don't ever want to be in the situation where I don't have the money to invest in a founder that I think is amazing at the stage I want. So that's something I didn't used to have flexibility in. I now have some more liquidity. Because so far it's pretty exciting. I've had 5x returns, which is not typical by this stage, so that's really exciting. So I have some great liquidity that is awesome. And just like Jennifer was saying, my liquidity is not all from Salesforce. It's not what everybody thinks from having started as an early person. How did you decide how much of your net worth you decided that you would be comfortable?
I mean, it was really organic because I didn't realize that I was going to do this full time, for a little while. And it also sort of came out of discussion with the important stakeholders in my life, with my budget, my partner, and thinking about family. So for me, it kind of depends on what we need to be in lower risk category, sort of long term, but it's changed over the years because we also have had a couple of good exits. So, but I do keep it to it's less than 15% overall.
Yeah. It's definitely less.
And I try to play with house money, as in take the returns that I have and use that.
Mine is actually now 10%. I've 10x'd my original budget, and it's now 10% of my entire net worth.
Always important though to think about which
is really scary, by the way, so I'm not recommending it.
That just a lot, but it's always important to think about who are your personal stakeholders and to make sure that it works for your life.
Very much so. Yeah, I had a panic attack about year 5 because I'm not too sure if we talked about the horizon of these things, but the exits, you really got to be on a 7 to 10 year plan. That's what so not only will the money may disappear, even if it comes back to you twofold or threefold, it's going to be a long time.
It's actually a really,
so year 4 or 5, I started panicking because I'd not been having a salary, which this was all brand new to me. The exits weren't happening. We'd had one exit for $100K, which was very exciting, but to divide $100K over 5 years was not a very good salary. And so I really freaked out. And then all of a sudden, year 6 and 7, things got really well, which is the only reason that I'm up to this percentage, because I've actually already made 2x of that percentage. So it's all very related. If I hadn't had those exits or that liquidity and decided to plow it back into the same thing, then there's no way I would be as invested as I am right now. So success breeds further stuff. If I hadn't had success, I wouldn't be doing it.
Okay, so you met the company, right? You came in, oftentimes it comes through a warm intro. You've kind of done your triangulation to say, okay, this is one where it's a great founder, believe in this team, enough of a good idea. They're going to be able to execute. I think I can help them. I want to help them. I like them. Okay, I'm investing. Okay, so then what it often looks like in the early stages is a convertible note. Convertible note.
Nothing happens and.
Nothing happens. Well, you sign on the dotted line. But what that dotted line often looks like in the early days, right, is a convertible note.
Or a safe note.
Or a safe note.
90% of what I do is
tell us what the safe note is.
So a safe note is a kind of convertible debt instrument. Convertible debt is basically giving you the opportunity to purchase equity in the company at a certain price upon meeting certain criteria. So when you wire your money to the company, you don't actually yet have equity if you're using a convertible note, safe or a KISS. You actually are basically buying the right to at a future date. Usually it's when that company gets another round of funding. Then you'll have an opportunity to buy in and have
oftentimes those notes, so the notes are pretty standard. There's something called the KISS note, which is slightly more favorable to founders. There's something called basically the YC note.
That's more favorable to investors.
Oh, sorry.
That's more favorable to founders. By the way, I've invested in 46 companies. I've never seen a KISS note. I would love to see a KISS note. I would love to.
Thank you for correcting. I only saw one. We haven't invested in the company. But usually it's the YC note. It's pretty standard.
It's safe.
But what it oftentimes has are 2 things to look for, which is one, is there a discount to the next round? Oftentimes it's 10%. It's sometimes 20%. Oftentimes 20. And then a cap. Right, a valuation cap. So those are things to think about, which is okay, and I've never signed one without a cap. Some people try.
The definition of a cap, just real quick, is the value that is being assigned, the value that the company is being assigned at the point that you are signing the convertible note, and that will be the amount that your percentage of ownership or equity in that company will come out of.
So basically, if you signed a safe with a 20% discount and a $25 million cap, what that means is if they raise the next round at a $40 million valuation, your calculation of what you get is either a 20% discount or a $25 million cap. In this case, it's bigger, so it's a $25 million cap. So that's why you want to do it, because you want to be able to, because you have no control over when they're actually going to raise that next round. And so, but just so that you guys know, it's fairly common. Some people are like, I hate notes. Everyone does it. I feel like everyone does notes.
It's 90% of what I invest. You don't have any other choices.
You don't have enough data actually to assign a valuation to the company anyway. And so
I actually hate the opposite. I hate it when people are trying to be forced to assign a valuation early on, because it's all made up anyway. And then people are like, I'm not going to invest at that valuation, and you're like, the company's been around for 7 months. It's entirely made up.
So here's a good question from Gina, which is what percent of the company at the super early stages would you expect for advisory and for vesting. So let's actually talk about that for a second, because you can put in money, right? But also all of you could also just get money. It could just get shares for advising. And oftentimes when you're advising, I mean, we could do a whole session on advising too, which is you should ask the early exercise. If you're advising. And so some of my early investments were actually, I got advisory shares, so they were super low price common shares as opposed to preferred. So they were, you know, a hundredth of the cost of what it would have been. And most of us are looking for common type returns, not just people who are going to get preferred. And so what's common, and I'd love to hear your guys' thoughts on this, is for advisory shares, it ranges from anywhere from like 0.1%, all the way to super early stage could be 1%. It tends to be on the higher side, and everything kind of in between. But usually it's a fraction of a percent, and oftentimes it's lower than 0.5%.
Exactly. That's kind of what I've seen, and it usually has a vesting schedule. As well.
Oftentimes it's 18 months, it's 2 years, right? Something like that. So that's very common.
I think you've answered that question. That's exactly perfect.
And so,
but I think sometimes people think of it as the same as if they're going to be an employee somewhere, and it's not the same. I mean, the percentages are much, much lower. And you have to, you know, and if you really don't understand it, then that's an opportunity to have more of the conversation with the founder and understand who else is involved and the team and what they're doing. But yes, it can be, you know, and that can still be very lucrative, but don't be expecting that you're going to be having a percent of the company.
And what's interesting is being an investor, I feel like I've been an investor, I've been an advisor. The mindset's a little bit different. Like I feel like it's just a little bit different when you're an investor versus an advisor.
I actually think of it almost as like, as an angel or very early stage investor, you kind of are an advisor by default, right? Because you need to
You're an advisor, but what I find is it's an investor, and again, is that investor, you sort of have the ability to look at the whole company and like have comments and get, and advisors oftentimes, I'm using you for X.
It's focused on.
It's very focused.
Particular.
And which is fine. That may be all you have time for. And then usually what you do try to do is get, and there's another question about how often you get updates. If they do it well and you're an investor, they send your investor updates. Sometimes it's monthly. Sometimes it's quarterly, sometimes if they're kind of crappy, they actually don't send them at all. Which I find really annoying, because it's like, I can't help you if you can't if you don't tell me
what's going on. Exactly. And that's one of the only other thing I ask for on the side note. I ask for pro rata and I ask for updates.
Okay, so we're almost out of time today. So I want to say thank you to Courtney and to Susan for all those people who joined today, and please do give us feedback on like what would be helpful. If you have follow-on questions, like please send them. Email me, Malin@OperatorCollective.com. I think you all have my email address. Like we want to know what they are, because we can also put together some FAQs. And then I want to turn it over to actually Monique, who has been awesome and amazing at putting this together. She has a lot of passion around making sure that we're educating this community, to tell us what else to look for and to expect.
Thank you. So just a few reminders and thank yous. Definitely want to thank our hosts today at Fenwick and West. They've been great in allowing us the use of their space here in Mountain View. Right after this call, you will receive a survey. You can see it up there on the screen, a few reminders. A survey via email will come out to you. If you can just please take 5 minutes. It's very short, just fill it out. This will help us greatly in our future planning. Additionally, there will be a session summary and audio link to today's session that will be emailed over the next couple of days to you. As well, earlier, Susan and Courtney, they posted a link, I think it was in the invite, that listed the various terms and definitions that we think you will find helpful. A reminder for our upcoming sessions that we're super excited for in February and March. Session 2 will be an anatomy of a term sheet, and this is beyond the basics, and that's with one of OpCo's LPs, Anat Meisel, who's a partner here at Fenwick and West. That is February 19th. And for our March session, that is Investing 101, Building a Portfolio and Evaluating Startups, and that is with another OpCo LP, Iris Choi, who's a partner at Floodgate Ventures. So want to thank everyone for participating today. This has been awesome. It's been our kickoff for OpCo investor education. So thank you.
And just anybody can contact me or Susan. You can find us on LinkedIn or in the OpCo environment.
The OpCo community.
Yes, exactly. But we'd be happy to help and answer any follow-up questions as well.
Absolutely.
Thank you two so much.
Thank you, guys.
And I hope everyone has a great day, and thanks for joining us during your lunch.
Yay!
All right.
Bye.